The American dream traditionally is defined as the idea that regardless of the condition of your birth, wherever your economic status or your class or where you're born or your geography, the idea is that in America, through hard work and perseverance, there is upward mobility. And you can achieve your God-given potential and you can achieve success regardless of your station in life. I really believe in that. I think Nebraskans believe in that. I think Kentuckians believe in that. I think Americans believe in that. But according to recent public opinion survey data, that idea of the American dream is waning, and especially among young people, Gen X, millennials, less so Gen X, but millennials and Gen Z in particular. You see this public opinion data that says that the American dream is slipping away. And that, and even parents of these younger professionals and younger people say that they no longer believe, by large margins, that the next generation will be better off than their generation. And that has been the trajectory of the American dream experience, is that each successive generation has more opportunities than the previous one. Our job, I think, as policymakers, is to restore the American dream, is to give Americans that sense of optimism once again. How do we do that? I believe that we need to reprivatize the American economy. Reprivatize the American economy through free market capitalism, because that is what has given Americans that upward mobility through free enterprise, entrepreneurship, and innovation. And that's what we're talking about here today. And in order to reprivatize our economy, we are going to have to unlock our capital markets. We're going to have to unleash financing for all of this innovation to continue to flourish and happen. And I think one thing that I like to say about my observations of the financial ecosystem in our country and what sets us apart and what makes us competitive in this country is the diversity and heterogeneity of our financial system. If you go to Europe, and I just led a bipartisan CODEL to Europe, or if you go to Asia or any other part of the world, you don't see that diversity. Mario Draghi, the head of the European Central Bank, former head of it, put out a recent report about what Europe is lacking. And they're lacking a competitive and dynamic capital market system. They have big banks, and that's kind of monolithic. They don't have the new business entrepreneurship ethic in Europe the way we do. You don't have any technology companies like we have in the United States. And the reason for that is there's less dynamism and less diversity in their financial system. Less, certainly, capital markets activity, more just large, globally systemic banks, but also less community banks. Mike's district, my district, Patrick's district, what we have, and frankly, what we have all over this country that's different than Europe and other places in the world, is that we have community financial institutions where most of the entrepreneurship, most of the new business formation happens. And I would submit, too, for those who may have a different political philosophy from me, that if you care a lot about financial stability and you think regulation is the way to get at that, I would submit that the key source of financial stability in our country, in addition to competitiveness and economic growth, is the diversity and heterogeneity of our financial system. The fact that we have distributed risk models where we have capital markets, yes, non-bank financial firms, big banks, regional banks, mid-sized banks, community banks, and micro banks, and credit unions. That diversity is actually what distributes risk and creates financial stability far more than central planning in Washington, D.C. Final preliminary point, and then I'll get into some details. What do we want as policymakers from regulators? We have the job as the lawmakers that the American people have sent to Congress to make the laws. Article 1, Section 1 of the Constitution says, all legislative power shall be vested in a Congress of the United States. A beautiful word, all, A-L-L, meaning that no legislative power shall be vested in an executive branch, administrative agencies. And yet, we have, in some cases unconstitutionally, delegated away our lawmaking authority way too much to unelected, unaccountable bureaucrats in the executive branch. Think the Securities and Exchange Commission. Think the Consumer Financial Protection Bureau. Think the vice chairman of supervision at the Federal Reserve. So we need to claw that back. And what we want as the oversight of these unelected administrators of regulatory law, we want certainty. We want stability. We want durability. We don't need shifting rules and uncertain rules. We need clarity and certainty for that private sector dynamism to take hold. And that's kind of a vision that we should have regulatory certainty and clarity, and especially in light of what the Supreme Court recently just did. I don't know if you followed the Bright Loper decision overturning Chevron, where no longer will federal courts defer to the interpretations of administrative agencies. That means that Congress must give clear direction to an administrative agency in order for that regulator to be able to provide that regulation. And that, I think, is a very important decision, because it means that regulators, unelected, unaccountable regulators, will have less discretion to interpret the law and make the law. And that restores democracy. That restores democratic accountability to Congress. So with all of those kind of preliminary thoughts in mind, what are the things that we've been working on that we view through that philosophical context? First is the Basel III Endgame. This has been a major point of oversight for our committee this last couple of years. The Basel III Endgame is this, it's an international standard set by the Bank of International Settlements Basel Committee for Bank Supervision, and various jurisdictions internationally are implementing it. The original idea was regulatory convergence on bank capital rules, and it's a vestige of the post-financial crisis efforts to provide financial stability. Unfortunately, the Federal Reserve, which is the lead banking agency in charge of this, under the leadership of Vice Chairman for Supervision Michael Barr, concocted a bank capital regulation that is actually incongruent with international Basel standards, and is in fact a gold plating of our bank regulatory capital rules. Now, this only applies nominally to banks with over $100 billion in assets. So these community banks are nominally exempt. But as you know, there's participation between community banks and those larger banks. Plus, we're talking about 80% of all bank assets in this country impacted by this proposed massive increase in regulatory capital. Why does this matter? It matters because not only would we no longer be harmonized with international bank capital rules, we would have higher capital rules to the tune of 16 to 20% higher capital rules than other institutions around the world. But it would sideline capital when the banks are already well capitalized. The chairman of the Fed, Jay Powell, the Treasury Secretary herself, and even Vice Chair of Supervision Barr, not related, admit that the banks are well capitalized. And this was really a regulatory non sequitur, because it was said that this was in response to the Silicon Valley Bank and the bank instability from March of 2023. But capital inadequacy was not the real issue there. It was interest rate mismanagement, deposit concentration risk. And so this was not a response to that crisis. The other issue is that if you really want to push lending activity outside of the bank regulatory perimeter, this is the way to do it. The demand for credit doesn't go away. But if banks become overregulated on their capital and can't make the loans and can't deploy that capital into the real economy, that's going to private credit. It's going to other places that arguably are less regulated and more opaque. I will spare you the details, but we have made tremendous strides in pushing back because of our oversight on this proposal. And because of that, I think we're in a much better place where we will get a reproposal in the lame duck. Yes, there probably does need to be a push for international regulatory harmonization on bank capital rules, but that should not be the ultimate goal. The ultimate goal should be economic growth and competitiveness of our economy, and we can't do it with over-regulation of bank capital. There's always risk with capitalism, but that's what made this country great. Newsflash, when you provide credit, there is risk associated with that. The answer is to provide the right balance and to make sure that overregulation doesn't suppress the dynamism in our economy. Another big issue, and I know Chairman McHenry might touch on this because this was his legislation and he led on it, was data security. And we passed and marked up out of the committee earlier in this Congress our Data Security Act. There's also a parallel effort by the CFPB to implement what's called 1033, which is a personal financial data rights rule that is a vestige of the Dodd-Frank law. But the bottom line on all of this with data security is that advances in financial technology have revolutionized our financial system, and that's a good thing. These innovations have helped more people access credit, access capital, and innovative financial services and products. But it also means, as we were discussing in some of the earlier panels this morning, that the amount of personal financial information collected on Americans is at an all-time high. And so balancing that innovation with data privacy is the public policy challenge that we have. And making sure that individuals have sovereignty over their own data is certainly an important objective. And so Chairman McHenry set out to modernize Title V of what's called the Gramm-Leach-Bliley Act earlier in this Congress. It's a technology agnostic approach. It gives consumers more control over how their personal information will be used downstream. It allows consumers to terminate collection of data or request that it be deleted at any time. And it requires that the privacy terms be transparent and easily understandable. The key achievements, I think, of our bill was, number one, to make sure that we achieved national preemption and to end this patchwork of conflicting and inconsistent state-based privacy rules. You may have heard of the California privacy law, the CCPA, or what they did in the EU, the General Data Protection Legislation, the GDPR. Well, what we need for innovation to flourish is standardization of that data, those data rules, those data privacy rules. So the bill achieves that, national uniformity. And the final thing I'll say about this, we were able to achieve this legislative product without including as an enforcement mechanism a private right of action. That is very important in terms of continuing to allow this innovation to happen so that we do not empower the plaintiff's bar to go out and sue everybody. We allow the enforcement mechanism to be the regulator. So I think this was a good legislative product. Why is it not law? It's not law because we have, number one, pushback from Ranking Member Waters because she doesn't like the preemption of the California law. And so we've struggled to get as many Democrats as we need on it. But the second thing is that there is a jurisdictional conflict between the Financial Services Committee and the Energy and Commerce Committee. And I agree totally with what your congressman said. Mike said that the Financial Services Committee should own this. And we do have jurisdiction over the Gramm-Leach-Bliley piece of this. But obviously the Energy and Commerce Committee has jurisdiction over technology firms. And so they put out their own product that contains a private right of action. So our hurdle going forward is going to need to be to get the Energy and Commerce Committee and our committee on the same page and also prevent this private right of action from really limiting the innovation that's happening in this area. A few other topics, and I'd love to open up for questions. The third-party relationship guidance. So Mike was mentioning that we had a field hearing recently in my district. He participated in it on bank fintech partnerships. And this is really, really important because as I talk about the diversity of our financial system, it's very difficult in some cases for those community banks to compete with mid-size regionals and certainly the Wall Street money-centered banks because they just don't have the capacity to invest in technology the way that those larger institutions can. And so we want bank fintech partnerships that allows banks and credit unions to reach new markets and new customers, but also because it allows these smaller institutions to compete with the larger banks that have the capacity to invest in technology. Let's face it, community banks don't have the ability to make these huge capital investments in technology, and the specialization of these fintech firms allow community banks to provide their customers with the services and products that they want in a modern world. The other thing about bank fintech partnerships that's so exciting is financial inclusion. And I see, Mike with Zest AI, a great example of this, where you can get into granular data and use artificial intelligence models to find people who are excluded from the conventional, traditional financial ecosystem and find creditworthy borrowers where they wouldn't previously existed in the way underwriting was done. That is really a revolution, that an application of AI in finance that really can make a difference in allowing people to access capital and pursue that American dream that we were talking about. Getting to those credit invisible below prime borrowers and actually providing them with access to capital, that is a huge, huge revolution. We were talking earlier today about cybersecurity and regulatory compliance. AI has that potential as well. Fintechs have that potential as well to protect against deep fakes and protect against cyber crimes and criminals, to help with fraud prevention. In fact, fraud prevention is one of the earliest applications for artificial intelligence, but improved compliance with legal and regulatory requirements. And let's face it, today, 8 in 10 financial consumers are using at least one fintech product. This is something we can all celebrate. So what are we looking at that could be an impediment to this innovation that's happening? In June of 2023, there was an interagency guidance on third-party relationships. This was the Fed, the OCC, the FDIC, all of the bank agencies that put out some principles for banks under federal supervision to consider when entering into these third-party relationships. There's certainly some advantages to harmonizing these rules related to third-party relationships, but it's paramount that regulators do not put out rules that impede these partnerships and stifle innovation. And we do think that, and we've received feedback from community banks, that the guidance that has been put forward does not give them the certainty and clarity that we were talking about that is required here. That the lack of certainty is not giving banks, community banks especially, the assurances that certain activity would or would not be permitted. And that's the death of innovation. Uncertainty is the death of innovation. So we're going to need to continue to do the oversight under this interagency guidance on these bank fintech partnerships. The CFPB, I know we have student loan servicers here. The CFPB is also a source of uncertainty and instability and a killer of innovation. And one of the many things that I'm worried about in the fintech space is this non-bank financial institution registry. And there is a final rule from the CFPB that requires non-bank entities, fintechs, to register with the CFPB. And if there have been any judgments or any kinds of administrative actions, whether they're valid or not, taken against these fintechs, they have to publish that with the registry. What this basically is a costly name and shame registry and forcing bank-like regulations onto these entities, one-size-fits-all regulations, that will stifle the innovation that we're seeing in this space. I'll let Chairman McHenry talk about the digital asset agenda that he's been pursuing so successfully. We need market structure for digital assets. We need that certainty and stability there, a regulatory framework, so that we can be the destination for crypto investment in the United States. And we also need a stable coin regulatory regime. You just heard the panel talk about the innovations that are happening in instantaneous cross-border and frictionless payments. This can flourish in the United States with a stable coin regulatory framework. So there's a lot going on in our committee, in this space, in financial technology innovation, in artificial intelligence as it applied to financial services, and in crypto. And our job, Mike, Chairman McHenry, my job, our job is to not fear innovation. And I'll leave you with one thought. Whether it's artificial intelligence or some of these incredible fintech apps that are out there, or what's happening in crypto or stable coins, you know, there's too much hand-wringing in Washington, whether they're busybodies in the regulatory agencies or some of my colleagues in Congress. Is there risk in finance? Of course there is. That's the news flash. That's what capitalism requires. That's what a dynamic, growing, competitive economy requires. But that's what the American dream requires. Risk, okay? And we all need to be smart, and we need regulation. We're not against regulation, but let's be smart about it. And when you hear people fear artificial intelligence, remember, people said to Thomas Edison and George Westinghouse, electricity can kill people. What are you doing? And then when Henry Ford invented the car, the automobile, the horseless carriage, oh no, you're going to destroy the horse industry. Guess what? The Kentucky horse industry is doing just fine. Okay. And when Steve Jobs decided to do this, people said you're going to kill the BlackBerry. Or guess what? I have a 13 and 11-year-old daughter, and they want Snapchat. There's risks, and we need to be smart about the technology. But how revolutionary is this? So when we talk about distributed ledger technology or artificial intelligence or the blockchain or crypto, do not fear it, embrace it, because this is the future of the American dream. Thank you very much. Should we have a question or two?
We have microphones, so raise your hand for Congressman Barr if you'd like to ask a question.
Mike. Well, I maybe inadvertently criticize my European counterparts, but in some cases they do better than we do. And there are some regulatory sandbox examples overseas that we should model. And I think that's a great idea. I think the chilling effect of the threat of regulation by enforcement, and by the way, the CFPB is worse than regulation by enforcement. I talk about this overturning of Chevron and reining in the administrative state. It used to be that when regulators misbehaved, they regulated by enforcement as opposed to notice and comment rulemaking, following the Administrative Procedures Act. But today, the CFPB regulates by threat, by press release. It's not even by enforcement. They don't even get to enforcement because they threaten a UDAP violation, and nobody knows what an abusive act or practice is because it's not defined in the law. It's like that old definition of obscenity. I know it when I see it. Rohit Chopra says it's abusive because he knows it when he sees it, after the fact. Nobody knows what the rules are ahead of time. So a regulatory sandbox is a great idea because it allows that innovation to flourish under regulatory parameters, but it gives innovators some safety and some security and some certainty. Like I said, that's what we want from our regulators. So great idea. By the way, the reform agenda for the CFPB is not just putting definition under UDAP. It's not just stopping this name and shame registry for non-bank fintechs. It's also to reform the structure of the CFPB itself. The Bureau is arguably the least accountable, least transparent agency in the entire constellation of federal bureaucratic agencies. Why is that? Because they're not subject to the congressional appropriations process. They're led by a single bipartisan director. There's no rigorous cost-benefit analysis. I mean, take, for example, the credit card late fee rule. This is an egregious example of real sloppy, lazy regulatory work, because they say, oh, well, wouldn't it be great to enact Joe Biden's junk fee agenda by capping late fees at $8? Who does that hurt? It hurts the 74% of Americans, many subprime credit card borrowers, who pay on time, because they will either lose access to credit cards that they need living paycheck to paycheck in a high inflation economy, or it means that they're going to have a higher APR. Why are we punishing on-time borrowers, including subprime credit card borrowers? This is supposed to be the Consumer Protection Agency, and what they're actually doing is hurting consumers. I've always said the best consumer protection is competition and choice. Allow consumers to walk with their feet. And I think the CFPB has lost that perspective. At least the Securities and Exchange Commission has a statutory mission of capital formation and efficient markets. The CFPB seems to want to regulate financial services and products out of the marketplace, stifling competition and choice. That is not consumer protection. I think we've got a question back here in the back. Well, that's a good question. In fact, we're having bipartisan conversations in the Congress what a post-Chevron world looks like. But the Congress itself does a good job in division of labor and specialization. We each have committees of jurisdiction. And I would argue that even if this poses additional challenges for the Congress as an institution, and maybe we do need to hire additional technical expert staff to live in a post-Chevron world where statutory law is given greater primacy in the lawmaking process over these regulations that come out of unelected bureaucratic agencies, I would say the overriding principle here is democracy. We're supposed to live in a system where the consent of the governed is in charge. And at least in the case of Congress, in the House of Representatives, it's every 2 years. In the Senate, it's every 6 years. The elected representatives of the American people are supposed to make the law. At least that's what Article 1, Section 1 of the Constitution says. It's also called the non-delegation doctrine. We're not supposed to delegate away the democratically elected prerogatives of the American people to unelected experts. I mean, they may be experts, but should they really be in charge? That sounds like Beijing to me. That sounds like Havana to me. That sounds like Caracas to me. It sounds like Moscow to me. I think that democracy works, and we should allow the elected representatives of the people set the policy of the country.
Yeah, Congressman, my question was around Chevron as well. Are you seeing in the short term the agencies have taken notice of that and maybe pulling back, or is it going to be on Congress now to clarify with new legislation to pull them back?
I see the agencies starting to recognize that this is a problem from the way they've been acting before. And by the way, it started before Chevron was overturned with West Virginia versus EPA, which created this so-called major questions doctrine. If it's a major policy question, regulatory agencies can't just make up the law. they have to cite to specific statutory, congressionally enacted policy in order to do what they are doing. And I think that's a good thing. Again, it's a restoration of democracy and democratic decision-making in large measure. And the regulatory agencies are losing. They are losing in court under these precedents. I mean, Gary Gensler is losing every case because he's just improvising on the law. And he's disregarding the Administrative Procedures Act. Chopra, hopefully, will be losing more and more on just making it up. That's not the American system, where unelected administrators just make up the law and enforce the law or threaten to enforce the law in order to force innovators and entrepreneurs in the private sector to conform with whatever views they have about investor protection or consumer protection. I think the best investor protection and the best consumer protection are robust, vibrant, competitive markets. And that's what we need more of to encourage the American dream to flourish in this country. And I think these legal decisions are really going to help facilitate that. Yes, ma'am.
Also around Chevron, one of the things that I would like to understand perhaps a little bit better is how are we going to make sure that things don't get delayed, particularly because if we're going to rely on Congress staff to be able to make difficult decisions, and you might need more people to support that, how do we make sure that things don't get delayed? That would be one question. The second one, you indicate that democracy is what is supposed to make us make good decisions. The electorate is not knowledgeable enough in many of the areas that we have to decide. So when we elect people to Congress, we of course are giving up our power to make decisions on everything to give it to you, but you yourselves are super busy, right? So an electoral system does not have the expertise to be able to make decisions that can be incredibly difficult. I mean, for some reason, specialties in medicines are so specialized, right? Because they are dealing with very complex issues. And something like fintech is so complex. I mean, some of the statistics that were given here indicate that companies are afraid because they don't know about them. So when we don't have people who have spent most of their lives in a single area, how do we make sure that you have the time, that your staff have the time, and that we don't lay decisions that are critical?
That's a good question. It's a good question. Respectfully, I think the concern about members of Congress not having enough time or not having the expertise is a little overblown. Chevron, the Loper-Bright decision overturning Chevron does not mean that no administrative agencies can exist in our system or we're eliminating the executive branch. No, far from it. We're just restoring the constitutional balance that Article 1 sets forth and provides for. It just means that Congress has to be careful about directing the authorities to those agencies, and those agencies cannot deviate outside of the statutory authority that Congress gives to those agencies, not to make the law, but to execute the law, to implement the law. And what we've seen too often is administrative agencies no longer implementing the law, no longer executing the law, but instead making the law. And that is not their constitutional role. So I respectfully, I'm not as concerned about that. And there will be a role for executive branch agencies to enforce the law post Chevron for sure. I think that answers your question. Are there any other questions or thoughts or feedback for us?
We have time for one more question if there is any.
Okay. Yes, sir. There you go. Paul. I'll try to repeat his question. Paul, that's a great question. So to repeat it so you can hear, the point is that the Chinese are, through the Belt and Road Initiative, are very active in this space, and they are trying to promote a central bank digital currency. Their no limits partnership, I'm going to improvise a little bit. Their no limits partnership with Russia is part, and their Belt and Road Initiative and getting their digital renminbi into the global south is part of their effort to de-SWIFT the world and their effort to de-dollarize the world. This is a national security threat. Now, some in Washington, especially some at the Fed and Treasury, think that our response should be our own central bank digital currency. Many of us on the committee think that that is exactly the wrong response. I have said, not just as a member of the Financial Services Committee, but as a member of the Select Committee on the Strategic Competition between the United States and the Chinese Communist Party, that we should not try to counter China by becoming more like China. Our advantage in this multi-decade competition, which is upon us, where the Chinese have made their intentions and aspirations very, very transparent, that their goal is by 2049, the 100-year marathon goal from the Mao Revolution is to supplant and displace the United States as the global superpower. It is an economic competition. Taiwan and national defense is a piece of this, but it's an economic competition. And I do not believe the United States or even other Western democracies, and we were visiting with the European Central Bank and the United Kingdom and what they're looking at in terms of exploring a central bank digital currency, maybe on the wholesale side, not on the retail side, because of privacy concerns and other issues, and because of manipulation of monetary policy, and because a retail CBDC in the United States would erode the deposit base of the banking sector. To a certain extent, there's a similar concern with stablecoins, but we cannot erode the deposit base of our banking sector. We need that deposit base to provide that dynamism and allow our banks to finance entrepreneurs and startups and homeowners. We need that. So what we're thinking about in terms of protecting the dollar's dominance and protecting the reserve currency status of the dollar is that instead of pursuing a CBDC in the United States, to provide what Patrick McHenry is doing and leading on stablecoins. A stablecoin framework with diversity, competition and choice, a state pathway, a federal pathway, so that we have a competition of dollar-backed stablecoins and put those babies out into the global economy. You want to protect the dollar's dominance, our global reserve currency status? That's how you do it. And you do it without compromising the privacy of the American people. You don't do it by copying or imitating China's central planning model and techno-totalitarian surveillance state model. Our currency should not be a surveillance tool of the government, but the idea of instantaneous and frictionless payments backed by the US dollar, that is the way forward, in my opinion. So thank you very much. Appreciate it.